Welcome to this particular session again. So we are now going to look at how companies are being managed or governed in its entirety. So we realized that in the previous session, we looked at how stakeholders impact organizations and the role that they play in each organization. This time around, the question is, how should we manage our organizations to meet the needs of the various stakeholder groups? Okay. Now, within our last session, we looked at one particular item that is principally dealing with how organizations are managed by managers or as stewards for the mutual benefit of the shareholders or the owners of the organization. We realized there were conflicts over there where sometimes managers may not be able to run the company in the best interest of the shareholders. So there was this issue of an agency theory, so that it will just ensure that agents who are the managers of the organizations work well or operate the organizations in the best interest of the principals, okay, of the principal. So that's the first issue we are going to consider over here. Again, it is quite interesting for us to know how things work out in terms of governance of the organization. Okay, so let's delve deep into how organizations are run by directors, by the agents for the interest of the shareholders. This time, we'll be limiting our study more with only listed companies or quoted companies which are listed on the stock exchange, okay? So we'll be looking at the definition of corporate governance. I mentioned it in my statement, how companies are run principally. The need for corporate governance, history and development of corporate governance. Here, I'll refer you to a particular document. It's quite detailed. If I want to cover all, it would take much of our time. And then the best practice in corporate governance practices and the benefits of corporate governance. This is a key and topical item in every AIB exams that we work in. So for all accountants in business, or even with the ACCA business and technology exams, F1, it normally comes up. So you always get questions on this, okay? Other modules will develop the ideas and provide more detail. We are going to take an overview, all right, over it. So principally, corporate governance, and this is picked from the Cadbury report, okay? Normally, the definition is tailored to the Cadbury report of 1992, which says that it is simply the system by which an organization is directed and controlled by senior officers, the directors, okay? So it's about how a company is run, and we are looking at only listed companies, like I said. Why the need for corporate governance? How did it come about? So over the past, we realized there were some corporate scandals where organizations were reporting fictitious numbers and trying to engage in, let me say, corrupt practices. Okay, so this led to criticisms of the accounting profession and the audit profession that they are not able to identify most of these corporate scandals. So it led to the point that let's institute some measures that will help block these leakages and these corrupt practices and fictitious transactions that run through the system, the fraudulent activities, okay? So you can see the Polypec video, okay? You can see the Polypec video is a typical and a topical item with in the areas of corporate governance, the scandal that rocked the organization, okay? So the public lacked trust in the accounting and audit profession. So a variety of measures were introduced, so they thought, well, let's put in some code of conduct that will regulate the activities of the managers so that they can ensure that the organizations are run in the best interest of shareholders and, of course, to the general public at large. So it developed over time, okay? The Cadbury committee sat on it, okay, led by the chair. Normally, these committees are named by after the chairmanship, okay? So like I said, I'll not go deep into this development or the history. I've uploaded a document on Aula where you find a historical breakdown of the development of this corporate governance code in the UK. So it started by the Cadbury report. They brought out a report in 92, which was corroborated by the Greenbury report. Sir Richard Greenbury chaired that committee, and they also proposed some directors' remuneration measures that should be instituted, after which the Hampel committee tried to say, let's consolidate all of this into one combined code. So they all brought together one combined code to regulate the activities of these directors in the organization. Later on, Tembo Committee also worked on it to institute or to propose some internal control and risk management measures. And then out of their report, there were sub-reports that came up. Okay, so we have all of these, and like I said, they all fed into the combined code on corporate governance. It has been revised over the time since 2005, actually, through to 2010, 2012, 2014, and 2018. The 2018 corporate code was effective from 1st January 2019. To the best of my knowledge, that's the current corporate governance code, which is being used in effect. So like I said, it took effect in 1st January 2019, and the key focus is on stakeholder and employee engagement, corporate culture, and remuneration. There is always a question about whether corporate governance should be viewed as principles-based or rules-based. When we talk of the rules-based, typically like the US SOX, okay, the Sarbanes-Oxley Act of 2002, which looks at typical items of avoiding or breaching these leakages that come out from the organization. But again, for the UK, it is more of a principles-based, where we're looking at typical proposals from the Hampel report, and then the corporate governance combined code. Okay, we call it the combined code, right? Out of these recommendations or the code, some recommendations of best practice were proposed. So it borders on the membership of the board of directors, where we should have some mix of non-executive directors and executive directors, okay? How directors' remuneration should be decided and how it should be disclosed. Most listed companies, you find them disclosing the director's fee as a separate report in their published accounts, okay? And then it's also looked at the roles of internal and external audit functions, and then the audit committee who works on these audit recommendations, and the right of the public to know how the organization is being governed. After all, every organization's activities borders on the public in general. Okay, so directors were split into two. The executive directors who are engaged in the daily operations and running of the organization, and the non-executive directors, they are not engaged in the daily running or operation of the organization. They are not employees who receive monthly salaries or wages. Sometimes they get some non-executive directors' fees, not much, but they have no links with the organization in terms of financial or any financial interest, yes. So they are not employees, no managerial responsibilities. They normally work like oversight committees, okay. So the executive directors, like I said, they engage in the daily activities of the organizations. They are responsible, they tend to report to the board, okay. They are normally at the head, at the topmost positions, okay. And it's the need from the proposal, from the corporate governance combined code, there was a need to have two different types of people, okay. So normally we have the chairman of the board of directors, and it is proposed to be a non-executive director who has no direct relationship with the running of the organization. And it should not be the same as the CEO or the managing director. The most important proposals from the code. Who are these nerds? Okay, like I said, they are not engaged in the daily running of the organizations. They have no business or financial or any contractual connection with the organizations, and they are normally appointed for a specific term. After their term is over, they are normally replaced by other experienced non-executive directors. Sometimes they roll them over, but they usually serve for a specific term, okay? And this makes them quite independent when they attend the board meetings, okay? The non-executive director is proposed for them to be at least 50% of the total board membership. And if it happens that way, you can see for sure the balance that occurs. Now, if you look through the recommended textbook, okay, from pages 276 to 277, somewhere even around 277 to 278, those two pages, we realize that there are items that normally spell out the independence of the of the NEDs. Okay, very vital, very important. One, it states that they must not be employees of the company in the last 5 years. They must not have any material interest in the company in the last 3 years. So if you were holding shares in the last 3 years, you cannot serve as a NED. Okay. They must also they must not participate in company share options or pension schemes. No financial links or connections with the organization. They must not have any close ties with the company directors or senior officials of the organization. My wife should not be the director of the company on which I'm serving as a NED. Okay. They must not also serve as a NED for more than 9 years in the same company. The duration after 9 years, you need to go off. So another new phase, experience phase to come on. Their key roles: they constructively challenge and contribute to strategic decisions, and they scrutinize the performance of the organization in general. They try to satisfy themselves that financial information is accurate, and they determine appropriate levels of remuneration for the executive directors, and they appoint and remove senior managers. Especially now, as they are very independent, you can be sure to know that they will recruit or hire people who are more experienced without any bias or favor. Advantages of NEDs: independence, excellent key item we should always mention. They are also experienced, they have knowledge about the activities they are undertaking, they have a wider perspective, and they have some comfort level. Non-executives are all full board members, so it helps them take constructive decisions that helps improve the operations and activities of the organizations. But nonetheless, these guys may have some disadvantages, all right? So they may lack independence. They are humans. Humans are all fallible. There could be prejudice of the board, okay, difficulty in imposing views, and they have limited time commitments. So you can see one NED serving on about 2 different boards. So in that case, you see them having limited time commitment for one particular organizations. The board, they are always responsible for major policy decisions of the organization, long-term decisions, and they should normally, the directors on the board should have a mix of skills and performance, which should be reviewed regularly. Once a year, there should be some performance appraisal of these directors, okay? Now, they should have the relevant expertise in the industry and the company in which they are running, and there should be a balance, like I said, between the NEDs and then the executive directors for independence purposes, for balance, to ensure that there is no favor, no nepotistic activities being run over there. And all directors should have training, adequate training, competent enough to run the organizations. And they must be appointed to conduct specific procedures. So they should be, and normally their activities, their appointments are done by the nominating committee. So you find this nominating committee running the recruitment and hiring of the directors. These nominating committee should be in place to select the board members. They should make recommendations to the board whom to recruit, whom they should promote, and so on and so forth. They will normally review the appraisals of these directors and make such constructive, relevant decisions. Now, normally the nominations committee consists of a majority of the NEDs. Why? To ensure that they hire without any favor. They have no links, okay? They are independent. So you can be sure that they will oversee the directorship appointment process in a very effective and efficient manner. And because they also have the skills and expertise, diverse backgrounds and perspectives to hire the right caliber of people for the organizations, okay? Again, we have the remunerations committee, and this is also one of the proposals from the combined code. So this remuneration committee, they will decide and set the pay levels for the directors. And normally it is recommended that there should be a minimum of 3 NEDs sitting on the remunerations committee, so that the executive directors do not sit there just proposing perks and bonuses for themselves when they are not required to be doing that. Okay. Now the pay should be based on the organization's performance level, or and then the individual's performance level. So we pay you in amounts which are commensurate with your input to the overall welfare of the organizations. The financial statements should disclose this. Like I said, most published companies, most listed companies will publish their reports with these directors be clearly stated. It ensures fairness, transparency, and parity. Advantages of the remuneration committee is that they avoid agency problems. It solves this agency problem. And also they leave the board free to make other strategic decisions for the organizations. The danger is that you scratch my back, I scratch yours. So it happens that sometimes the NEDs will just scratch the backs of the executive directors, and they will also give them some good pay or sitting allowances, okay? So this extra committee layer increases cost to the business. One other disadvantage is sometimes a cost, okay? There's a point to note that we should know that the remunerations committee, they set executive directors' pay, okay? They set, and the question is, who do you think set the pay of the NEDs? The non-executive directors, who do you think sets? Is it the same nominations committee or the executive directors? Who do you think sets, or the entire board, right? The answer is so clear, okay? I'm not sure the NEDs will set their own pay, all right? So the whole board of directors will set their pay. Now, the audit committees, they are normally independent. They work with the external auditors and also supervise the internal audit function. They are the ones who normally review the financial statements, the financial published account, audited accounts. They review the internal control and then try to ensure that the audit recommendations are implemented. So they ensure that risk levels of the organizations are reduced to a minimum. They are normally a balance of executive and non-executive directors, and all listed companies which are quoted on the stock market should have one audit committee. The advantages, if you consider deeply the Cadbury report, it gives us a number of advantages that they improve reporting quality. They create a climate for discipline and control to reduce fraud and misappropriations. It also enabled the NEDs to play a positive role and provide a discussion forum for financial directors and strengthens the external auditors' position. In fact, it also boosts the morale of the internal audit committee, since they will always work with this audit committee, and strengthens their position, makes them more independent, okay? At the end of the day, public confidence in the company will rise if it happens. Information to public. Public is a stakeholder to both listed and non-listed companies. They have a right to know, and the companies must publish their financial accounts for them to know. The corporate governance also states that we must comply with all the requirements of reporting, or if we are not complying, we should explain why. Okay, so directors must report on how they comply with the code. If they are not, they should give explanation why they are not complying. And this must be audited by an external independent auditor and report on it accordingly. So like last week's tutorial questions, take a good look at the Stagecoach financial statement part A, and you will see this issue of comply or explain. Some things they are reported on, some things that are key to report and information about the board, brief information on the remuneration, audit, and nominations committee. Relationship with the auditors, and then how directors have reviewed the internal controls, how effective are they? Statement on whether the company will continue to survive as a going concern, okay? Now, benefits of corporate governance to the organization. Key exams points, you should know, it helps in business success, it boosts investor confidence, and there's a minimization of wastages and fraud, and it helps to meet the listing requirements on the stock market. There's one more aspect that we need to look at before we bring this discussion to a close. So corporate social responsibilities. Every organization deal with stakeholders, and they must try as much as possible, not just to maximize returns for the shareholders, but to also run the company in an ethical way to meet the needs of the wider stakeholder body. So the impact on of our activities as a company on the society, we need to look at it. Are we polluting the air with more carbon monoxide, or destroying the water bodies with some cyanide emissions or pollution? So it is very key. How secure are our goods to the general health of the public, okay? So CSR is a set of actions that organizations is not obliged to take, but does so well. So it is voluntary normally. So they do it for the stakeholder body, all right? So it is still an ill-defined concept. Some have various legs. We call it sustainability reporting. We call it integrated reporting. We call it sustainable development. It's evolving. So sustainability is becoming a key item in most business reporting practices, which we cannot do away with. Let's examine a car manufacturing company, okay, in your own time, on your own, not in groups. So if it were face-to-face, you can do it. Unless you have a friend you can discuss with over the phone, not face-to-face, please. So you ask yourself, for a car manufacturer, who are their key stakeholders and what are their needs? Okay. So key benefits of a CSR, okay, they attract customers, good reputation in the system. If you don't do it, there are some reputational risks you can incur. And then they help to retain and attract good employees, avoid taxes and fees for pollution, and they help us cut down costs, okay. There could be disadvantages you can think of them. So just 3 of them is that there's increased source of sourcing materials from ethical sources, quite expensive sometimes. Cost of turning away business because it's not ethical. It's of course, if you only think of, thinking of money, you go for it. Then time taken for planning, implementing, and then ensuring that these CSRs are implemented in a logical and efficient manner. Okay. So summarily, this is what we have in terms of corporate governance. They require us to do it to bridge the gaps on what the society expects of the company. All right. And it helps with our reputational risk to reduce it. The principles that we've looked at in terms of corporate governance and CSR, public expects companies to follow them, both angles. All right. 2 quick questions. The separation of ownership and control is only relevant in the context of limited companies. Is it true? Ownership and control, is it only for limited companies? CSR is concerned with the company's obligation to just its external stakeholders. Remember, we mentioned that it helps employees. So even internally, there is some benefits of CSRs, okay. Which of the following are true, are true? So I just explained it from my narrative, the way I'm just putting it, okay. You can see that it is not one or the other, it is both. All right. Okay. Which of the following is true? Okay. So you realize that it is not any of them. Either you go for all. All right. Okay. Quick, another one. So what proportion of board members of a large listed company should be made up of the NEDs? What proportion? Is it half, 1/3, 2/3, or 1/4? Normally we said for balance purpose, it should be half, 50%, right? All right, thank you very much. So we'll look at our next item when we are done with this. So try as much as possible, like I said, to work on the tutorial questions. Okay, there's some good tutorial question on this, CSR and then corporate governance. And we'll then delve deep into the next phase of the accountant in business. Thanks and see you soon. Bye-bye.